So you've probably felt it, right? That kind of feeling of uncertainty in the air. Well, recent reports have just confirmed what many of us were suspecting. The US economy is slowing down. So today, we're going to break down exactly what that means and, more importantly, what you should be watching for next.
And that brings us right to the big question, the one on everybody's mind. The US economy is slowing down. So, should you be worried? To really get to the bottom of that, we got to dig into the actual numbers. All right, so let's start with what we know for sure. We're diving right into the hard data that shows the economic engine is, well, it's losing a bit of steam.
So here's the headline news. Economic growth, what we measure with GDP or gross domestic product, it came in a lot weaker than most people predicted. To put it simply, the engine of our economy just isn't running as hot as it used to, and we've got the numbers to prove it. And wow, this chart right here really puts it all into perspective. I mean, look at that. After a few quarters of really strong acceleration, you can see that super clear downturn in the latest numbers. Now, it's not a full-on screeching halt, but it's definitely a significant tap on the brakes. And that leads to the real question. Why is this happening?
So let's pop the hood and see what's going on. In this next part, we're going to explore the main forces that are putting pressure on the economy right now.
The economy is a super complex machine, obviously, but economists are really pointing to a couple of key things that are driving this cool down. Let's dig in and see what they are. Okay, so it really boils down to two main drivers. First, it's us. Regular people becoming a lot more cautious with our spending. And second, it's the very deliberate actions of the Federal Reserve. Let's break down both of those. This quote right here really nails the first driver. Think about it. The cost of living is still pretty high. There's this general feeling of uncertainty. So what are people doing? A lot of households are cutting back, especially on the big stuff. And when millions and millions of us decide to spend just a little bit less, well, that creates a huge ripple effect across the whole economy. All right, the second big driver, interest rates. In simple terms, that's just the cost of borrowing money. Now, the Federal Reserve, the Fed, they have two main jobs: keep prices stable and keep people employed. To fight that really high inflation we've been seeing, they've been raising these rates. It's basically their go-to tool for cooling down an economy that's running too hot. And this is where you see the domino effect in action. It's perfect. The Fed raises rates. Suddenly, things like mortgages, car loans, business loans, they all get more expensive. So what happens? People and companies borrow less and they spend less. And the natural result of that? Boom, economic activity slows down. And in a way, this is exactly what the policy was designed to do.
Okay, so what does all this actually mean in the real world? This slowdown isn't just some abstract number on a chart. It has real, tangible effects on two areas that matter to pretty much everyone: jobs and our money in the financial markets.
And the two places you really see this playing out are, one, the job market, which, let's be honest, has been incredibly strong for a while, and two, the financial markets, which are always trying to guess what's coming around the corner. So on the jobs front, the news is actually still pretty good. The unemployment rate is still at a historic low. But we are starting to see those signs of a cool down. The pace of hiring is slowing down, which tells you that businesses are also getting a little more cautious about what's next. And the stock market? Well, if there's one thing the market absolutely hates, it's uncertainty. Slower growth just makes investors nervous, plain and simple. And that nervousness, it can lead to a lot more volatility, those big stomach-churning up and down swings in your 401k. And what you're seeing here is a classic flight to safety. When things feel uncertain, some investors just decide to dial back the risk. They'll shift money away from things like stocks and move it into what they see as safer havens, like bonds or even just plain old cash, basically waiting for the storm clouds to pass. Okay, so this all leads to the big one, right? The question on everybody's mind: does a slowdown automatically mean we're sliding into a recession? And this is a really, really crucial distinction to get. A slowdown just means the economy is still growing, but at a much slower pace. Think of a car that's gone from 80 miles an hour down to 20. It's still moving forward. A recession, on the other hand, is when the economy actually starts to shrink. The car is going in reverse, and it stays that way for a while. So what are the experts saying? Well, the general consensus right now is that no, we are not currently in a recession. Instead, what we're seeing is a transition, like we're getting off the post-pandemic bullet train and settling into a more moderate and hopefully more stable pace of growth. Okay, so with all that said, what comes next? For our final section, let's look at the key signals that are going to tell us where the economy is really heading from here. The thing is, the path forward isn't set in stone at all. What happens next with the economy really depends on a handful of key reports and big decisions. And you can bet that everyone from Wall Street to Washington is going to be watching these things like a hawk. And here they are. These are the big four indicators you're going to want to keep an eye on. Number one, what is inflation doing? Is it going up or down? 2, is the job market holding strong? 3, are we, the consumers, still out there spending? And maybe the biggest one of all, how is the Fed going to react to all this new information? This pretty much lays out the playbook for what could happen. If inflation keeps falling back towards that sweet spot the Fed is aiming for, they might actually start cutting interest rates to give the economy a little boost. But if inflation is stubborn and stays high, well, then those interest rates could stay right where they are for a lot longer, keeping the brakes on. And that really leaves us with the ultimate question, doesn't it? What policymakers are trying to do here is pull off that famously difficult soft landing, slowing the economy down just enough to beat inflation, but without sending us into a full-blown recession. Whether they can actually stick that landing or if we're in for some more turbulence, well, that's exactly what the next few months are going to tell us.